Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
Hello, this is Fergus Hodgson with the Gold Newsletter Podcast. My pleasure to be with you. Thanks for tuning in. We're speaking today with two of the most influential and well-known investment analysts, writers, and lecturers in the world. That's Anne and Pamela Aden. And they're also long-time attendees, speakers at the New Orleans Investment Conference. They're based in San Jose, Costa Rica, and they're co-editors and publishers of the Aden Forecast, a monthly investment newsletter. Welcome to the Gold Newsletter Podcast. It's a pleasure to have you.
Oh, thank you. It's a pleasure to be with you.
That's great. And so you're in Miami right now?
No, we're actually in San Jose, Costa Rica right now.
Okay. And just out of curiosity, your bio said that you moved there in 1974. Are you originally from the United States, or what's your background?
Yes, we're originally from Southern California.
Okay, great. I've been to San Jose. I live in Guatemala, so I'm not too far away.
Oh, really?
Yeah, but that's a different topic, but it's an interesting element of your story. Now, the bit that jumped out at me from your latest note was, quote, the US dollar is a key reason why gold and silver have been weak. And Brian and I were just looking at the federal funds rate, which is targeted at 1.75 to 2%, which in real terms is still essentially zero. How can an interest rate basically at zero in real terms be expressing strength in the dollar?
Well, that's very interesting. That's exactly, in fact, what we're writing for our next issue right now. The real rate is still zero and below, depending on which rate, and so that's still good for the gold market. But the fact that it's just rising from the dead, in other words, like especially a short rate zipping up like they did, even though it's really nothing in terms of, well, it's going from 0 to almost 2%. That's the target. That's really still very low, historically very low, but it is, in the meantime, influencing the dollar, we believe, on an intermediate basis, and the dollar was due anyway for like what we call a contra-trend rise, which is an intermediate rise of the major trend, which is down. It has been down since it peaked a year and a half ago. So we're looking at this rise. In fact, the dollar index is resisting exactly at a spot that's a key spot. It's called the critical juncture right now of 95. And it's been resisted. It tried to go above it, but it's basically resisting. So what we were watching as a target resistance major area is there right now, while gold's sitting at a low that at least reached last Monday. So we're at a spot right now on an intermediate basis that happens to be short-term because it's happening right now, but it's really an intermediate move right now that we could be seeing the temporary highs in the dollar and the temporary lows in gold right now.
And when we see this index, the dollar index, you say there seems to be some sort of barrier or threshold mark at the 95 level. Is that because other central banks are pushing back or responding?
Well, in part, but see, 95 just on a technical basis is the high of the last quarter of last year, and it's also a key area in terms of moving averages in that. So, that's the level we were looking at. If it went clearly above that, then perhaps we are at the beginning of a serious rise in the dollar, and that hasn't proven itself yet. But yes, and plus it seems like the current administration isn't really interested in having such a strong dollar, which is also important. And yes, the other central banks, there's still some monetization going on. There's still that, but we feel that their currency has gone far enough. Like in the commodity currencies are a little different. When we're talking about the euro and the yen, those two have actually been holding up above the lows for a couple months now. So actually, they're not so bad. The ones that were really bad, that were hit most, is the Australian dollar and the Canadian dollar, but now the Canadian dollar is getting a little relief from the oil price. But unfortunately, the resources right now are still struggling to look for a bottom, which we think is going to be coming up pretty soon too.
Right. So, but your basic inference is that this stronger dollar means that the price the gold price as denominated in dollars will be lower. Each dollar is buying more. But then you said elsewhere that oil may be leading the way out of weakness for the precious metals and resources. What do you mean by leading the way? What is the relationship between the oil price as a forward-looking or as an indicator for the precious metals and resources?
Well, basically, the energy and resource sector tend to move the commodities, and we call them the commodities, but those are that specific area of commodities, and the precious metals tend to move together. They'll have a lead and lag time, and it happens often. It's not that they're in lockstep, but there is a relationship on a major trend basis, and we feel that that oil has been showing its strength for its specific reasons. We agree, but nevertheless, it's been rising, and it's even poised to rise further. And in fact, the energy shares, just as a detour, haven't really caught up to the oil prices much as they could. So perhaps we're just wondering if maybe that would lead the stock market and maybe its last or another leg up in the bull market it's in. It's to be seen. But it's interesting that oil is really like a key right now. And even though copper keeps falling, that's that barometer for the resource sector. It's very sluggish. It's kind of worrisome, actually, a little bit. But we're still watching it very closely to see if there's going to be a turn in the resource versus the energy. So it's still in process. But yes, they do tend to move together on a major trend basis.
For more than 40 years, top financial experts and private investors from all over the world have gathered for the New Orleans Investment Conference to discover new opportunities and strategies, exchange ideas, and plan for the coming year. To learn more about today's investing environment and updates, join Mark Skousen, Peter Schiff, Brian London, Robert Kiyosaki, Doug Casey, and dozens of experts in this year's event from the 1st to the 4th of November. Go to NewOrleansConference.com to register today.
Pamela, Brian here. Great to talk to you, by the way, and get your comments in person. In a case of great minds think alike, I would hope. I've also been talking about this 95 level on the dollar for, I guess, 2 or 3 months now. And I was very enthused to see, or happy to see, that you're talking about that very same level. And in fact, your son Omar, who publishes his own trading letter, was talking about, and has been talking about 95 as being a key level as well. I look at that as like you say, it's been a level of resistance for some time now. I think going back well into 2017, and it also seems to be, from my little, very rudimentary charting, that it's a downtrend line too for that dollar. It just seems to me, from both the technical and fundamental level, that there is a longer-term downtrend for the dollar, but that tends to run counter to the consensus. Everybody's talking about how the euro's headed downward because of all the political problems and issues over there. And it seems to me that the longer-term argument is that the Federal Reserve is in the back half of its tightening program. And in fact, that could end much more quickly or much sooner than anyone is really predicting. And then you look into Europe, you look at the Bank of Japan, and you look at the Bank of England, and they have yet to begin their tightening programs. Yeah, so it seems to me, longer term, the smart money is already shifting toward those other currencies.
Yes, we would agree with that, Brian. And I think it's something that's going to surprise a lot of people, because everyone is, like you say, thinking that Europe is in trouble and what have you. But it's not. I think the trade tensions, as they continue to intensify, assuming that they do, and it sure looks like they're going to, this could be really something that kind of flips everything upside down, so to speak.
And then looking at gold, that's an argument that gold has bottom. In fact, your last letter was at the end of June, and that was kind of coincided with my putting out my last issue of Gold Newsletter, our July issue of Gold Newsletter. And my comments at the time, way back, last week, as it were, was that everything was negative for gold. We'd broken through 6-month lows. All of the charts were arguing that it was, making a bearish argument for the metal. And there was just so much pessimism out in the air. And what I wrote in Gold Newsletter was, I'm really excited about this. I think the metal's going to bottom, at some point within the next week or two. And it seems, and I'd like to get your views on this, that in the interim over the last 3 or 4 trading sessions, that perhaps gold has in fact bottomed.
Well, yeah, absolutely, Brian. We agree. We think very possibly last Monday's low on a closing basis could have been the low for this decline. And if we look at just the highs of January compared to the low last Monday on a closing basis, it hasn't even been a 9%. It's less than a 9% decline. And so really, that's not that much compared to the pessimism that's around. And it also has not changed the big picture that's, to us, a turnaround, turning bullish time period. And this low combined with the upcoming rise, which we think could happen at any time, like you said, if it's a couple of weeks or if it's last Monday or whenever, but it's coming soon. We're still in a 5-year saucer bottom. And the last 2 years has been a turnaround. So what'll be important for us to see is how well the upcoming rise develops. If it were to break, like for example, because that rise would be in all the phases that gold has. In a bull market, it tends to be the strongest rise that we're coming up to, and which could be from now into the fall. And if it breaks, say, 1380 as the maximum, then really the bull market is exploding. But even if it rises back just up to there and stops, that's still a really good rise for the major picture. It's still good. But so it'll be depending on how strong that upcoming rise is. We're watching that very closely. But we do feel that gold has a bright future in the coming years. And whether it be this upcoming rise or the next one, we think it's just a matter of time.
That's really interesting. You know, I've looked at and one of the things I've commented on in Gold Newsletter is that the typical summertime rally since the bottom in 2015, it has been about 10% at a minimum. And if we get that minimum 10% rise in this, late summer, midsummer to the fall rally, then that will put us back in those key levels. I've looked at the key levels as being, around 1372, which was the 2016 high. A lot of people looking at 1360 is a key point. And I find it interesting, you're saying 1380, and that's, it's all kind of the same thing.
We've been saying 1360 to 80 because there's a spread there. The highs, you're right, is 62 and 70, but if you want a clean break, it's 1380. So we kind of have that as the high side of that range of high, because that range of high is also a 5-year top of a huge saucer bottom. So technically, that's an explosive thing. So if that breaks, that's why we put 1380 up there. But really, if it was breaking 1372, we'd be extremely happy. But now we just put it there because that was part of the bear market, a high way back in 2013. So no, that's the only reason we have it there. It's really a little bit lower.
And in fact, if we had that much momentum and if we broke that level, my thought is that we'd get over 1400, which is a level that, a lot of the kind of amateur gold watchers, the people who really aren't focused on it, who are more generalist, look at the charts and they say, wow, after 1400, there's very little technical resistance until you get, right up close to the old highs around $1,800, $1,900. In fact, I was talking to Ralph Akampora about that a while back, and he just volunteered that same point, that once gold gets over $1,400, it's just got plenty of room to take off. What's your view on that?
Yeah, absolutely. That whole area is really the stickler. But one area that's interesting is the 1536 level. I know that's kind of a weird number, but that was the base before the bears. That was the base it was holding. Gold was holding at very well for a good while until it broke down into a bear market in 2013. So that level, since it was a big support, could be a resistance if we look at that. But if it breaks that, then yeah, there's nothing stopping it really, all the way up to the old high of 1900. So yes, we think that there's not the top side's wide open, and I think it'll be surprising a lot of people. I think this last almost 6 months now that we've had this dreary dribbling down, and only now has it really come down finally. And what was interesting, too, is that the fall in gold of the last month was equivalent to the rise of the dollar a few months ago. Now they kind of switched roles. The dollar was resisting at 95 when more or less. So but they're both at that October, November low or high, whichever you like, the dollar high versus the gold low. They're both at the same level. If you look at them, they're both at that holding or resisting at that level. Yeah. So they happen to be at key levels now. One just got there faster than the other one. And so they're actually now in sync. And so this will be very interesting. It's coming really close.
Yeah, and I think that's another important point that you bring up. The inverse correlation between gold and the dollar index has been very close. On a historical basis, it's been very close over the past couple of years or so. So
yes,
it's very interesting. You know, the dollar's rise has almost exactly corresponded with gold's decline over that time frame.
Exactly. Yeah, it is very uncanny right now, because sometimes it's not so perfect, but this time it really is.
And you know, we're looking at the upside for gold. If we're looking at $1,500, $1,600 range or something along those lines, as a target, if we get above 1,400, that would imply, you know, that's probably 20-25% gain in gold, but that would imply for the mining stocks that have such leverage to gold, you're talking about the average mining stock would probably go up 200-300% over that time frame, I would think.
Oh my, they have such upside potential in that sense. Because, in fact, what's interesting too is another reason why last Monday is looking a little more interesting as a low is the gold shares have been very perky over a week now.
Right.
And so the fact that they're perky for no reason is actually, I think, telling, and could be trying to tell us that gold indeed wants to bottom now. And they certainly are bombed out in every sense.
Yeah, and the gold-silver ratio seems to have topped out. And as we know, a falling gold-silver ratio is another sign of a very healthy gold bull market.
Exactly. See, there are a lot of signs coming up, and they're all coming up around the same time. Same with gold in several currencies. If you look at gold, how it looks in all the currencies, and you look at them, say, go back to 2005 and take a look at them, they look good. And the wave is up for gold on all of the major currencies. So it's not just a dollar-related event, which is good to know, which is another bullish sign for gold when it's strong in all the major currencies.
Mm-hmm. Well, you know, we've seen what the upside can be if, in fact, gold is bottoming right now, and it's pretty good. I mean, we're talking about mining stocks going up 200-300% if, in fact, this is a new rally in gold, and we are at key levels. But what do you think would be the risk here? If we're wrong about everything, if this is a false breakout or a false bottom, what's the downside picture look like from your standpoint?
Well, the downside would be that gold would have, if gold breaks the key lows, we would have to then say, yeah, we got to take a break. That's probably not going to happen. If that hasn't happened, like 1250 was one of the key levels. It slipped below it, but it quickly bounced back. So if it truly broke 1250, say 1240 now at this point for a clear break, then and it goes down to say the 1200 level, we could say, well, maybe that's an aberration and it's a whip. But much lower than that, we'd have to say, yeah, we better take some time out. So, but it would all depend on how the gold shares look and how silver looks and how the whole environment looks. Because actually, some of the gold shares have done very well. They don't even look like a gold share, like Kirkland, like Nico. We can look at Wheaton Precious Metals looks great. Like they've all have done very well, and more. It's just I'm mentioning those, but if that's a sign that everything else is going to go with it, is very good. Like we said, we're more optimistic, and think that this is a time. Another thing that's interesting too is the rare coins are now priced. Some of them are priced similar to the gold price. It's like the same gold coin that you get. You got like a Maple Leaf or an American Eagle. You can buy for the same price as some of the key numismatic coins, which we find very interesting because that's never happened. I mean, that doesn't happen. That usually in the bull market, they're way much higher. So that is another sign showing how gloom and doomish things are for the metals itself. So we think that's an interesting sign as well. And the fact that platinum is collapsing, and it did last week and this week. So that too could say, is that the last whip we're getting? Like all these things seem to be coming and trying to tell us something, and so we're still listening.
I would just say that one of the important factors, and I have another article here from you, it's titled Interest Rate Strategy, A Lot Depends on Your Age. And you note that when the Fed tightens, recessions have followed it in nine out of the last 11 cases. And then you give a few bits of data pointing to the likelihood that actually the US economy more broadly could go in a negative direction. And presumably that would lead any kind of rise in the gold market. Do you want to comment on the likelihood of a recession?
Were you saying if we do go into, say, a recession because of the tightening?
Yes, exactly. That would lead the breakout you were just discussing before.
Well, it's actually right now it's interesting. We really don't have any real concrete signs that a recession is around the corner. And I think part of that is because interest rates are coming up from such extremely low levels. They're still low, even though they've been coming up. So we really don't see a recession coming around the corner, which is also a good thing for gold. And if anything, we're seeing inflation perking up, and that's yet another good sign. So we're seeing more positive signs for gold and fewer signs that a recession is around the corner. Now, that doesn't mean, obviously, there's going to be a recession sooner or later, but it's looking like it's not going to be within the next 6 months or so far.
You know, the yield curve, we're watching the yield curve closely too, like many people are. Like the T-bills, if they were the 90-day T-bill rate goes above the 10-year yield, then we would start worrying that perhaps maybe recession is coming soon. But as close as they are, they're still the short rates are still below the long rates, and as long as that's the case, I think we're still okay. I think that'll be one very telling sign for if a recession's around the corner or not.
And even if the curve inverts, that indicator still has a considerable lead time before a recession, historically.
Yes.
But
it has quite a big lead time. So there's another good indicator, which is the index of leading economic indicators, and it tends to turn down before recessions, and it's still way up near the record highs. So, and it's as you say, the yield curve. If that does invert, there is quite a big lead time, and it can be up to, I think, even a year. So we don't see a recession coming right up.
Okay.
I have to agree. I'm not seeing any signs of an impending recession, but it does bring up a good point that I've been making lately. That if you look at the two primary paths that the U.S. and even the global economy could take, it's either going to grow or it's going to moderate and perhaps start decelerating. If we have a growing U.S. economy and growing global economy, then that puts pressure on all commodities. We have inflationary pressures, and we have kind of a classic setup for gold, and that's bullish for gold. On the other hand, if we have a deceleration, if we go into a recession in the U.S. especially, but even if we have kind of a global slowdown, then that's going to lead to more Fed quantitative easing. I mean, at this point, they have to go directly to QE. They don't have enough room to really lower rates. And that in effect would be enormously, in this day and age where every economic slowdown is met by an avalanche of liquidity from the central banks, that's even more bullish for gold.
Exactly. So it's kind of a win-win, really, because you're very right. They don't have room to maneuver. They're kind of in a corner, and that would be probably the only thing they could do is just bring QE back if things got bad again. So it's a really interesting situation, and it's very very unique in the sense of we don't have a lot of past situations that were similar. So it's kind of like, seeing and playing it as it comes along and seeing what the options are, which are becoming fewer and fewer.
Yeah, it's not so much what's going to happen, it's more of a timing issue, and that there's going to be bumps, and some of them pretty scary along the way, but it seems like long term, whichever scenario does play out, it's going to end up being bullish for gold.
Yes, we agree. We agree with that, absolutely.
Well, we think the same about you, Brian.
One more piece of evidence, huh?
Yeah, we're coming up to the end of the half hour, but are there any points that we didn't touch upon that you want to get out? Anything that maybe we overlooked?
Well, the world markets compared to the U.S. market have been sluggish, but that's about all we've had. We haven't really touched on that much, but we don't have to.
Sure. Well, people, if you want to follow their work, it is adenforecast.com. That's ADEN forecast.com. And I will share also the articles at equities.com. One is titled Interest Rate Strategy. A lot depends on your age. And the other one, which is relevant to what we just discussed, rates will have to move up quite a bit before they affect the market. Otherwise, Marianne and Pamela, thanks so much for your time. And we look forward to having you back on the show in the future.
Oh, thank you. It was a pleasure.
It really was.
Excellent.
Thank you very much.
Cheers.